Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cents segment with me, Pete Wargent from Alan Wargent Property Buyers, and I'm here with Chris Bates from Flint Group. Chris, g'day.
Hey Pete, how you doing? I see you're in the sunny Gold Coast, but not so sunny in that room. But how's it going up there?
It is a bit dark. It's a beautiful day out there. I'm just at the Pines. If anyone's familiar with the Gold Coast, so I'm just speaking at an event this week. I think Mark Boris is presenting today. And just like everywhere else in southeast Queensland, the place is booming. Everything's packed, traffic, construction. And that's not just Gold Coast. That's if you go south of Ipswich, Caboolture West, they can't build stuff fast enough up here. So just the whole southeast Queensland part of the country is absolutely booming. But beautiful weather up here, and you can hit the golf course Thursday morning. So yeah, can't complain. How's your week been?
Oh, it's been good. We did 3 nights camping up near sort of Foster, near Seal Rocks there. And we had some, the good and the bad with the weather, a beautiful sunny day. And then we woke up to a wet tent another day. But the kids absolutely loved it. And, it was a group of 5 families, 10 kids running around. And it was an amazing weekend, but exhausting in the same breath as well. Packing up, packing down, packing back up. It's been a bit of a journey, that the camping, but they absolutely loved it. What's our big 3 stories this week, Pete?
Always nice to get back into your own bed, isn't it, after a week of camping? I'm actually going over to Western Australia next week. I haven't been over there for various reasons for a number of years with all the travel restrictions. So I'm looking forward talking about booming parts of the country, looking forward to seeing what's happening in Perth and WA. So lots going on. I guess in the theme or the thematic of booming parts of the country, we've got the latest inflation figures out over the past week or two, and that's actually shifted market expectations for interest rates, shifted the cuts further out, and even some possibility of a hike. So I think that, it has an immediate knock-on impact to housing market sentiment. So we'll talk a bit about that as the first story. Budget night is coming up pretty soon now, actually. By the time this goes to air, budget night 2024. There's been some push from the crossbench senators to look at tax reform, specifically negative gearing, capital gains tax discount, the usual suspects. So we'll talk a bit about what the Labor Party might be looking to do there. They've got a fine line to walk, I suppose. They need to keep the economy humming without stoking inflation. And then third story, well, it's kind of related, I suppose. What's the government going to do about housing supply? I think the budget will talk a bit about a push towards build to rent. So we'll get some clarification around the new tax incentives in that sector. And we'll talk a little bit about what other governments and state governments are doing around the country to try and push this supply side of the story. It seems to be a recurring theme, I suppose, not enough housing at a time of high population growth. So, Chris, let's start with that story on inflation. So inflation figures came in. It was 1% for the March quarter, which was a bit higher than market expectations. And actually, if you look at where the inflation was, people say don't cherry pick the sort of parts of inflation, but if you actually look at it, it's really the sectors that have been directly impacted by very high population growth. Education prices rising, 12-year high in inflation there, medical costs, and in particular rents. I think the figures for 2023 were somewhat impacted by the Commonwealth rent assistance, but as that washes out, now rental price inflation is really surging. Highest we've seen really since the global financial crisis. And I suppose this has really shifted market expectations for interest rates. No cuts priced in anytime this year. And in fact, if you look at maybe July, August, it's an each way bet as to whether we get one more hike. So we can talk a bit about the optics of the Reserve Bank and what they're hoping to achieve. But are you seeing when people come to you for a mortgage, is there a bit more caution around what might or might not be happening with interest rates as the year goes on?
Yeah, absolutely. Anyone can just type into Google. If don't jump off the podcast, bad advertising that. But jumping off after this podcast, jump onto Google and type in rate expectations graphs, right? And you can have a bit of a laugh that how bad we are at predicting anything in the future, to be honest, but also rates and how bad we've been over the last few years. And you can constantly see, you know, we thought rates would go much higher than they did, and then we thought that they would stay really low. And then, you know, so I think this is just, it's like a seesaw at the moment. And I do think it really does change sentiment quite fast because everyone's reading what everyone else is reading, right? And it gets into the media really fast. And then, you know, people start perpetuating a certain story and people jump on the bandwagon and starts to prove the, you know, their confirmation bias because they get new data that backs up their story they've been saying the last few years. And I think people get a bit confused, right? I think ultimately inflation's heading in the right direction. Is there some stickiness that's surprising people? Is unemployment staying lower than people that the RBA really wants? Yeah, absolutely. But is it heading in the right direction? And, you know, around the world, yes. But there is also at the moment the seesaw going back and saying, well, actually, it's not going down as fast or as far as we want. What we might need to do is increase rates again. And that's not what buyers were thinking 3 months ago. And also sellers. And I think this is, I've mentioned it on this podcast so many times, how there's both ends to the property market. There's people entering the market, and there's also people who need to exit to re-enter or just want to exit. And I reckon this concern around rates being high is not going to be great for a lot of things, right? Firstly, if you're an investor, that desire to hold on is lower, right? If I can sell at a decent price right now, and it stops me having a big shortfall because rates are going to be staying lower or the higher all the way through to 25, 26, and my negative cash flow, and I've got a bigger mortgage, I'm getting out, right? And so you're going to see more investors bail if rates stay high. Same vein, I reckon you're going to see less investors want to enter. You know, the reality is that cash flow shortfall can only be sustained, even on a, you know, a high yielding property. You know, a lot of people are going to say, do I really want to sustain a higher cash flow and higher interest rates when I've got a bigger mortgage on my house as well? So I think it's not going to be great for the rental crisis, which isn't great for our rental costs, right? Because you're going to see more investors bailing, tighter rental supply, less investors entering. And so that's actually going to keep pushing up our rental inflation, right? So it's actually counterintuitive, and rental costs are probably one of our bigger costs in the inflation. I reckon with the buyers and supply, I did a post on LinkedIn yesterday because when you look at the housing market, Melbourne's a bit different to Sydney and other states, and Brisbane's off the charts in terms of how tight housing market is up there. Ridiculously tight the last 3 years. But Sydney market and housing is kind of, you know, each year we go, oh, there's this going to be a great run up in listings in autumn. So many more listings on the market. All the media report or listings on the market. If you look at data, it's nowhere. It's just like averages, and then it really dies off. You know, there's a front running of listings, and then listings dry up in autumn. Then the same thing's been happening in spring. Oh, listings are off the charts in early spring, and it's going to be a boom in listing. And everyone's going to be rushing to sell, and then bang, nothing really comes on. And I think that's going to be the story in late 2024. If you think about this time, May, June, it's when listings dry up. No one really wants to sell their house in winter. And they want to sell it in spring. You know, it's when buyers come back with renewed energy and renewed confidence. But so you might see a bit of a front running of listings, but I think it's going to be really disappointing in the Sydney housing market and the Brisbane housing market, to be honest, because investors are going to be really stuck. So I think this higher rate expectation is going to stop sellers, upgraders. Absolutely. I still think first time buyers, if you can get into the market, you know, an extra 25 or 50 basis points, when you've got a rental crisis and you've got, but it's really hard to enter the market. The data coming out right now is getting worse and worse to show that it's the haves and the have-nots. The people who are on higher incomes have got the ability to borrow money, but genuinely speaking, have also got access to some type of intergenerational wealth. And it's really a transfer of wealth happening right now. It's, you know, it's only making our inequality because people entering the market who are only to enter the market when there's massive headwinds, higher interest rates, high borrowing capacity, they're the ones who are going to benefit when that flips to a tailwind. Now, it might not flip in the next 6 months, might not flip in the next year, but at some point it will, let's assume. And those people who entered in 2022, 2023, 2024 are going to be like, oh, yeah, we benefit from that price rise. And the people who couldn't enter because they didn't have the income or then generational wealth are going to have to potentially not be able to buy or have to pay a lot more. And I think that's the real story that's happening right now with interest rates. So, look, I think it's, you know, I've rambled on enough here, P, but I do think there's people on each end of the spectrum. There's people who are going bang a drum and saying, right, we've got to raise rates another 1%. And there's people who say, no, place under control. Don't cut too late. And And then all the, general thing is there's groupthink with all the economists who are all just thinking what everyone else is thinking. And so I think this is going to be an interesting thing to play out where rate expectations just keep on flipping.
That does make sense. I think if for most people in the housing market, like it's a slow moving beast. And I think if you look at, without getting too technical, if you look at the modal distribution for 2025, has it changed that much? No, not really. So for most people in the market, take a longer term view, maybe look at 3-year yields as a kind of guide or something like that. For the people who are following it more closely, or if you're under mortgage stress, let's just step through what's happened with the numbers here. So the Reserve Bank, a lot of this is about optics and consumer expectations, but we got a bit of a free kick this quarter. So year on year, inflation fell from 4.1% to 3.6%. So at least the Reserve Bank can say, hey, look, things are still moving in the right direction, because a big reading dropped off if you think about the year on year figures. But looking ahead to next quarter, well, that may not be the case. So if you look at the core inflation figures, this quarter we went from 4.2 to 4. So still moving in the right direction. But next quarter, the figures that are dropping off, the core inflations were 0.9%, trimmed mean inflation in the technical terms. So I think next quarter, if trim mean inflation is under 0.9, at least they'll be able to say things are still moving in the right direction. But if we get another sticky quarter like we've just seen, then they might well be forced to do something. And that's why markets are pricing that each way bet of something happening 3 months from now. I think the problem for the Labour Party, there are some things, as you mentioned, that are particularly the price of goods coming down. But we've now got fuel prices. I saw yesterday, just looking around the traps, 212 cents. So that's pretty much back to a record high. So there's some challenges there about there's parts of the inflation basket that aren't really being impacted by Australian interest rates. As you mentioned, rent, medical costs, petrol prices, things like that. And yeah, the RBA might just need to be seen to be doing some more in a few months' time. So yeah, look, a lot can happen between now and then. Not least, we've got a budget night to be navigated through. But yeah, I think it will give more people pause. Certainly, any expectations of a cut for 2024 have pretty much evaporated. And yeah, high population growth, as you mentioned, we can't really build fast enough for the demand that's there. So yeah, lots going on. And but for most people in the housing market, usually it's best to zoom out, tune out the noise. But if you're under mortgage stress, obviously a level of concern.
Yeah, one thing I think we're just going to be looking back on in 3 or 4 years' time and say we've really disrupted our rental stock. We've really changed the makeup of where we've got rental properties and where we've got a lack of rental properties. Now, typically in the past, investors would go to capital cities, a lot of them would go to units, and they would go into the housing market because they could afford it, they had the borrowing capacity, and they could sustain a negative cash flow. I think what's happening over this period, and I think it'll keep extrapolating out over this decade, is less and less people will enter into the capital cities. They've learned the lessons with apartments. They can't, and they'll start entering more in the regional locations because of the tight borrowing capacity. And it's they go there because rates are higher and they can't afford a negative cash flow. Now, whether that's a great decision or not, that's another discussion. But I absolutely think it's happening, right? And so what's happening is you're starting to see less and less rental stock in our capital cities, particularly in the housing market, and more rental stock created in these regional locations. And from an investor in growth, actually, that's going to be great for growth, to be honest, in the city. But we are going to see rental supply and the ability to rent in the capital cities harder and harder because the market's going to get more and more driven by owner-occupiers and less rental stock, with less press, more difficult to rent and higher rents. And higher rents are then going to force people to buy as well. And that's going to, so then that's, I think what's happening at the moment is there's this real shift. So if you're a buyer's agent and you're buying regionally right now and you're buying for investors, it's a pretty good time compared to in the past. A lot of investors would go for the more safer bet, buying close to the capital city. But I don't know whether that's something I just think is playing out because of how tight borrowing capacities and how scared investors are to leverage up. And I think that we're going to really see in a few years' time this rental crisis continue and actually get worse in our capital cities.
I've watched Simon Kustenmacher from the Demographics Group, where he worked with Bernard Salt, talking demographics. Twice I've seen him present this week. And one of the key themes was the return to the office push. And as he pointed out, there's arguments on both sides of that equation, but certainly we're not going back to how things were. I think the balance of power at the moment is very much in favour of employees. I think more people have set themselves up to work from home, and we maybe are going back to some kind of hybrid model. But he made a really good point in terms of the rental stock, and that is for people who need a home office. I'm finding this right now. I'm in a hotel room with no space. You actually need an extra bedroom or a separate space, and that's created more demand for rental accommodation than probably we needed 3 or 4 years ago, with more people spending at least a couple of days working at home. So that hasn't really helped, and we have had a change in the distribution of where renters want to live and how much space they need, and that hasn't helped. And of course, this is putting a lot of pressure on state governments and the federal government to tackle the rental crisis. It's a big part of the inflation basket, as you mentioned. And if we're going to end up with this hybrid model where people are working 3 days in the office and 2 days at home, that's not going to go back to how it was. So, yes, and in that context, I guess we've got the budget night 2024 coming right up. So that's kind of our second story this week, Chris. So should we flip on to that one and take a look? Well, look, the polling hasn't been great for the ALP. Still, I think, ahead on most of the polls, but I guess the fine line that the party has got to walk. So Jim Chalmers, the treasurer, will be, I guess, he's got to be sort of seen to be not stoking inflation. I think spending is still quite high. If you look at the structural spending, revenue is high as well because unemployment rate, as you mentioned, is still under 4%. Commodity prices have been quite high, but there's still quite a lot of government spending structurally. Now, in the context of housing, a couple of the crossbench senators, Jackie Lambie and David Pocock, have proposed another look at negative gearing, capital gains tax discount. I think, look, the Labour Party pretty much lost the 2019 election looking at exactly those policies. So I would dare say they probably won't be looking at those areas again directly. I think especially when the rental vacancy rate is the lowest in history, it's probably not a great time to be making wholesale changes to the way rental properties are taxed. That's my gut feel. And I think, look, the budget is probably going to be close to or in surplus anyway, due to the low unemployment and high resources prices. But I guess the government, there's a couple of things from an optical perspective. One is, are they going to look at curbing population growth in some way, maybe looking at student visas? But I think the other thing is there's going to be, I think, a big push towards institutional investment in housing. So we should get more clarification around how build-to-rent properties are taxed for corporate landlords and developers. And I just wonder whether there might be some budget handouts just to mechanically reduce inflation. We saw rent assistance previously. Energy costs are still high. So there's a few things to watch out for there. But the main thing from a housing perspective, do you think they'll take a look at things like negative gearing and CGT, or do you think they might just give that a miss this time around?
Look, I think personally, if you're going to make that change, it's probably not a bad time in terms of a lot of investors and a lot of properties have been repriced. I think if you was going to do that when a few years ago, back in 2019, I think you would have really created a bit of instability in the property market and potentially created some really big falls where the negative cash flow on those properties, because rents have gone up, because a lot of investors have bailed. If you were changing your negative gearing right now, I think it wouldn't be a bad time, right? Because some people have seen some growth and they could get out. But is it a good long-term move? I don't think so. I think ultimately what you are going to do is really penalize new investors entering, and we're just going to exacerbate our problems out in the investor market, right? And our rental crisis. I think, a better bet is to go for CGT. But if you're going on CGT, you've got to be really careful. Be careful what you wish for, right? If you were to invest, you're going to be paying more tax on any investing that you do. Whether it's shares or property, it'll be the same. And so we're going to be paying 37.5% tax on our capital gains versus 25%. Do you really want to vote for a lot more tax? I think that's a big question. I think that's an easier win because ultimately, 37.5% capital gains tax, because you only get a 25% discount, or a 30% capital gains tax if you're on a 40% tax rate, is closer to what you would have paid in income tax. And so it's a little bit better for inequality, where, you don't really make huge advantages for the people who have got money, who can pay themselves low salaries and build all their wealth in capital gains, and then never pay capital gains tax because they never sell. And then they live off the equity. And that's ultimately what a lot of the people with money do. So, I think that's a better bet. I just think you got to be really careful, playing with negative gearing. That also apply to shares as well. A lot of the things that you people do use to build wealth would change with that tax policy. So you just got to be careful. Ultimately, if you disincentivize investors, less investors will enter, less investors, and you'll start to really disrupt our rental crisis even further. So I don't think you can do that unless you had a huge building boom and things that really, encouraged investors to re-enter. But I just don't think it's a great idea.
A lot of these debates came around in 2019. I think one of the proposals this time is whether negative gearing should apply to new builds only to encourage rental supply, but not to established properties. I think I get it in principle. I think the Parliamentary Budget Office has done some modelling on this, and you would probably get some pull forward of demand as people make decisions prior to the changes, but then investment would drop off after the introduction of the rules. I do think you could potentially see maybe a sugar hit of construction for new apartments and things like that as people sort of lured towards the tax benefits. The risk is always, as we often talk about on this podcast, if you're buying a new apartment with tax benefits, well, when you come to sell to the next person, they won't have the benefits of the negative gearing, and you're creating almost a two-tier market and potential for loss on resale. I think CGT could get a look, maybe to encourage people to invest for 5 years plus, potentially if it was a tiered or graded tax rate for CGT. But we'll have to wait and see. I think the bigger challenge is it's a very tricky budget for the Labour Party to deliver because, yes, the budget might be in surplus, but they can't really risk stoking inflation again because another interest rate hike would not be politically popular for people with mortgages at the moment. So, and obviously the government can't be seen to be encouraging that by spending too much or inflating the economy. So, yeah, it'd be interesting to see. It's a fine line to be walked there, or the narrow path, as they call it. So, yeah, pretty interesting. So, Chris, the third story, which is kind of related, really, on the supply of housing. So, I think the budget is going to push the build-to-rent legislation with incentives for developers, and we should get some more sort of clarity around that. I think we do have some build-to-rent in Australia. There's lots more in London, in my part of the world. There's whole boroughs where there's probably most of the new supply now comes from build-to-rent. If you go to a place like Wembley or somewhere like that, plenty of boroughs around London where, half the suburb might be, new supply of build-to-rent. I saw there was a project in Auckland went live this week, and I was just surprised by just how high the rents are. $900 for a 2-bedroom unit, New Zealand dollars. So you could certainly make the case that the build-to-rent stock itself might not be an affordability solution in its own right, but I suppose in theory, if you build enough of it, it creates more supply, takes pressure off other parts of the housing market. I saw there was a planning approval went in this week for 400 build-to-rent units in a greenfield site in Canberra. So there's obviously a shift in that direction, and maybe the budget will try to incentivise more corporate landlords.
Yeah, I do think this is what we're going to see in the budget is, it makes sense, right? If you could really reduce the taxes, the GST, investment taxes in build-to-rent, and even potentially some of the developer taxes, I think ultimately the cost to supply those to market would be cheaper. You could create better investment returns for people who have got money to invest in them, and you would create 100% rental stock rather than, selling some of them to first-home buyers. And maybe the first-home buyers can buy off other investors exiting. But, I think it's if you can get a lot of the super money in particular and overseas money into the build-to-rent story, and they do great developments, high-quality developments that are going to stand the test of time. I think that aligns to the build-to-rent philosophy, right? Which is always going to, rather than building something to sell it to an investor and passing the buck to, mum and dad investors, right? And everyday Australians trying to build wealth, maybe you can't pass the buck anymore, right? Your super fund's going to hold it long term. And so if they build nice quality, build to rent stock, it's 100% adding to the rental supply. and it's giving people long leases, then you've got to argue it's a good thing, right? I think you have to be worried, though, if they're building great build to rent in areas where you own an apartment that's high density that isn't built that well. As an investor, I would say, as a renter, why would I say rent this when I could rent in this nice build to rent that's got all the facilities like a co-living, and it's a really nice build and I could stay as long as I want, and then renting a high density apartment that maybe is on a busy road that's not got great views and it's tiny and it's got building issues, etc. And so you've got to be really careful, I guess, if you own those properties anyway. But ultimately, better build to rents getting built en masse around you. You have to say, why would someone want to rent your property versus the other? And so I do think this build to rent story is going to really continue, but the reality is it's not really going to move the needle, right? So you got 11 million properties, even if they went and built 100,000, I think the forecast is around 30,000 at the moment. You're talking like, a minuscule amount of new rental properties onto the market. I do think it's a lot over long term. These things compound and you start to create a proper player in the market, but it's very, very early days. It's a really slow moving beast. But I do think they're going to do things to encourage that, but that's going to take capacity away from what we would have used to build other apartments for first time buyers. Well, it's going to take capacity away what we would have used to build apartments for downsizers, and taking capacity away for downsizers is not a good thing because that then frees up housing market for people to upgrade into. I think we should really be encouraging that type of development, the things that people will leave houses for, because that reallocates our housing supply. The person who maybe a couple or even a widow is living in a 4-bedroom house, and a family with 2 kids are living in a 2-bedroom house. Wouldn't it make more sense if that family could upgrade into the house? Well, they can't, because the person doesn't want to downsize out of that house because they can't find something they really want to move into. And so I think that's one of the keys to unlocking a much better allocated housing or property supply, is creating supply for downsizers. And so I'd love to see some innovation there as well to really encourage that to happen more.
A couple of points there. You mentioned capacity. I think one of the capacity constraints we have had over the past couple of years has been in the construction sector. And this week we saw another major builder collapse, this time in Western Australia. This was a 60-year-old business founded in the 1950s. So it's another really big scalp. And this market cycle is proving to be pretty tough for the sector, because that's now 2,349, according to ASIC, construction and development firms that have collapsed over the past year. Now, some of this I think would be expected, but a couple of years there where we more or less had a moratorium on insolvencies through the pandemic. But this is a big shock to the system. So that's one of the issues that in some ways we're struggling to find the capacity to build as these firms die. Now, of course, there's some phoenixing and the contractors move on and find other work. But yeah, we're struggling, I think, to keep pace. I saw temporary visas hit another record high in Q1, over 2.8 million. So there's a lot of demand, especially for rental stock. The other thing I noticed this week, Chris, actually, it's partly anecdotal. First day I got to the Gold Coast, went out for an Indian meal, just went for a curry down at Emerald Lakes, and there was a massive Indian wedding on down there. Came back to the resort where I'm staying, the Gold Coast. First night, massive Indian wedding, and you can imagine how big these are. This is 200 plus people. And then there was another Indian wedding the next day. ABS figures out this week, Australia's Indian-born population has continued to explode to 846,000 in 2023 financial year. So a decade ago, that figure was 378. So that's more or less 500,000 extra people who not Indian heritage. That's people who are actually born in India. The Chinese-born population has increased over the same period, but nothing like as dramatically. I think there's been a sort of a relative shift towards Indian-born population. Relations with China have cooled somewhat over recent years for various different reasons. But the English-born population, on the other hand, is falling. I think there's a number of reasons for that. I think a lot of people like myself, my age bracket, well, our parents are getting old. The exchange rate isn't what it used to be. I think a lot of Brits used to come here because they like the idea of buying the McMansion or that Sylvania Waters style property, which isn't as easy as it used to be. But I think if you just look at Simon Kustenmacher was talking about this week, our overseas-born population is the highest in 130 years, but we're not picking and choosing countries. It's just if people have got the qualifications, they want to become an international student or apply for residency, if you meet the points, you're in. And I guess Asia is the closest part of the world to where Australia is. So I'm just circling back to your point there. I think the types of properties and the types of areas that people want to live are going to be changing, because there's far fewer Brits, and the Indian-born population is very soon going to be the largest cohort. So that should overtake England in the next year or two. So there's changes in the demographics as well as the numbers.
Yeah, I do think, so another story this week is the Chris Minns government in New South Wales is doing some, you got to call it once in a generation change. You know, a lot of people throw those unprecedented words and big words around, but I do think what he's doing is extremely brave. It goes against what, decades of policy has been in the past, building greenfield estates, building high density apartments, right? And then allowing townhouses and graded flats in the middle and outer suburbs, right? That's kind of what we did. But what he's saying is that's not going to work long term. We need to cut up the property market and create the missing middle. And the way we're going to do that is change zoning around key spots around our city, and particularly great areas where there's great public transport. It also ties into the tens of billions of dollars they're spending right now on the metro, not just the northwest to the city, but then the city to the southwest, and then the city to Parramatta, which, that's not meant to be live to 2032, but that'll come around very quick, right? All the stations have been determined. The tunneling machines are already starting to build that. So, when you type, all that investment, and then also people are leaving Sydney, particularly the younger generation, the people who, the human capital that they would add to the city. They're trained, they're educated, they will add a lot of money to our economy, them and their family, and their spending over the next decades. So them leaving is not a good thing. It's, it's one issue that a lot of countries around the world have, the brain drain. And so Sydney doesn't want that. And it also wants to be able to attract talent from around the world. And so, I think that's a real issue right now. And the government's sort of leaning on that and saying, okay, let's change the status quo. And they really are. And so this month, we're going to be really interesting to see what developments get approved, because I think in the May 14, they can start to get approved that wouldn't have been approved last year. And how is that, changing those suburbs? 6 to 8 levels, particularly 400 to 1,200 meters, depending on the train station, is getting rezoned. That's a big area. And developers may have that land. If not, they're going to be able to try to acquire it quickly. And that's going to change feasibility. I think it's going to be very interesting to track this story over the next 5 years. Developers are only going to go and only going to build where they can make a profit, though. They're not just going to go and build for fun unless there's a really good margin in it. No developer wants to be that developer that went under this week, and one of the others that went under over the last couple of years, the hundreds of them probably. So it's really going to, even though rezoning happens, it doesn't mean that's going to get built. But some of that rezoning, particularly on busier roads, they can acquire the land better, they can get bigger builds, they're going to be able to sell it. I think developers are going to absolutely, have options, which they may not have had before, because, if they built in the areas of high density, maybe they can't make a good enough margin because those properties haven't gone up compared to other areas. But maybe now they can open up new avenues and areas that they can build and make a profit. And so I think this is a big story, and I think we should just track it over the end of this year to see what actually gets approved, because there's going to be a lot of community backlash. It's very topical. I was just reading the Pittwater Peninsula living yesterday as well. It's all over the pages on the beaches, even though the beaches aren't even on that list. The people are like, oh, this could happen up here. We need to fight it. So, it's a big story.
There'll be plenty of pushback in that part of the country. So, definitely, it's like a mirror image of the Auckland story from a few years ago. More opportunities for upzoning or more supply, but whether it gets built and how much, and whether it's a cyclical issue or not, we'll have to track as it goes on. So, main story this week was the inflation figures. I think if you look at the monthly inflation figures, it's gone from above 8% all the way down to around 3.5%, but it hasn't been a smooth journey. This is now the third time we've seen a bit of a snapback. But I think, if you went back to 15 months ago, 12 months ago, we're pretty much on track with the Reserve Bank's forecast. So it's not panic stations yet, but if we get another quarter and if there's no progress next quarter, then there will need to be some action taken. So that's what has been spooking markets this week. Other stories, budget night coming up and a push towards build to rent, among other things. So if you've got any questions or topics you want us to cover, as always, do follow the link in the show notes. We're always happy to take questions and feedback. So send us those. If you want to have a chat to me, Pete Wargent Blogspot is my daily blog. I have to write something today, actually, too busy looking at the golf course. And if you want to have a chat to Chris, where's the best place to go? Link in the notes.
Absolutely. Jump in the show notes. I think probably 500-600 people or something have done that now. So we'd absolutely love to help others if they want to have a chat. So look forward to having a good chat next week, Pete. Enjoy the golf course. Hope the presentation goes well. And happy Sunday to all our listeners.
I'll be over in Perth next week, so I'll have to find a brighter room than this one. It's a bit dark in here. But look forward to chatting then. And have a great weekend, everyone.
Thanks very much.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.